Morning, welcome to ANZ News. It's Thursday, 27th August, getting closer to the end of the week, and the US has got some massive news coming in tonight, which we're going to talk about today. Tonight, the US Fed chairman will address a virtual gathering of central bankers at the Jackson Hole conference. He has flagged enough of what's to come to have economists all frothy with expectation, to wit the CNBC headline, Powell set to deliver profoundly consequential speech, changing how the Fed views inflation. So, what is the expectation and why is it profoundly consequential? Like our RBA, the Fed has a mandate around maintaining both inflation and employment at acceptable rates. Historically, that has largely been around ensuring neither run too hot, i.e. tightening monetary policy or raising rates and containing new money supply to slow things down. The GFC saw an unprecedented and globally coordinated central bank response of the opposite amid crashing inflation and surging unemployment. Zero and negative rates became the norm, and unprecedented money printing under the newly coined, pardon the pun, name of quantitative easing being unleashed. But it hasn't worked. The problem now, of course, is we have a new recession upon us when they didn't even fix the result of the last. And so the US now has official numbers of 0.8% inflation and over 10% unemployment. The official rates, but much worse in reality. Whilst inflation is always hard to get after the GFC, the narrative was always about not having too much easy monetary policy in fear of it getting out of control and overshooting their 2% target. What makes the pre-talk of this year's Jackson Hole conference so important is the message they are prepared to further ease and, more importantly, let inflation overshoot before tightening. Below is, and next shown is a chart courtesy of Bloomberg of the US inflation over the last decade. Check how low that was around 2014. Far out. When you overlay that with US interest rates, you can see that they got excited in 2017 when they saw inflation crack through that 2% and straight away started rising rates in fear of losing control. Check out this next chart here, Back to the Future, for showing those percentage rates. As we now know, the amount of debt in the system and the utter reliance on central bank easy money support narrative for shares came home to bite. After raising rates to just 2.5% and a program of quantitative tightening, the opposite of easing, the share market tanked at the end of 2018. And as you can see in that previous chart, the Fed had to lower rates and stop this quantitative tightening program. This wasn't new. Each time you stopped QE 1, 2, and 3, the market corrected. This was not a share market on fundamentals, it was one running on stimulus. But always in the background was a Fed signaling it wouldn't let inflation get out of control. And that is what makes tonight so important. They have already signaled they will let it run hotter for longer before tightening. They need to see inflation to erode all of the debt that they've generated, but they can't raise rates and increase the service costs on all that same debt. It is quite the dilemma. Historically, 4% was considered a neutral interest rate. In 2018, 2.5% nearly crashed financial markets. The problem is, where do you go when you're already near zero? Negative? What many economists are expecting tonight is the Fed to adopt an average inflation targeting, or AIT. Whilst that might sound innocuous, what it means is that will let inflation run hotter than they like to essentially make up for the lost sub 2% years. The issue with that is, how hot do we let it go to let the average catch up? Bank of America Merrill Lynch modelled this with alarming results. If price level targeting was implemented when we hit zero lower bound in late 2008, and we assume the price level was 100 at that time, the price level now would be 117 versus a target 2% year-on-year price level of 122. At this point, it would take 42 years to reach the price level target if core PCE remained at 2.1% year-on-year, or just 2 years if core PCE rocked to 4% year-on-year. While these scenarios are extreme, they demonstrate the large variation in Fed policy regimes that could result from adoption of price targeting. And that probably sounded quite complex, but in essence, it means if they jump that inflation rate up quite high, they're going to catch up on all the years they've missed out on inflation. There's a few charts shown here next as well. Chart 2 and Table 2. 42 years of zero interest rates and QE is probably a little long, and maybe has other unintended consequences. Cue sarcasm, but you can see the temptation, or indeed the need, to run much hotter to achieve a result in an ordinary period of time. Just imagine the social and economic fallout of 4% inflation if they want to do this in 2 years. We say social as well, as remember the Fed of dual mandate that sees full employment. That is set to change too, and this from Bloomberg. The Fed is also expected to codify change in its approach towards achieving full employment. In the past, officials shied away from pushing joblessness below what is considered its long-run natural rate out of concern that it would lead to too rapid inflation. Now, the emphasis is on the benefits of a strong labour market for the economy and society. They're not going to act to cool off the labour market unless it's generating unwanted inflation, said Nomura chief US economist Louis Alexander. That's essentially walking away from the concept that there is a natural rate that is irresponsible to push beyond. Powell had said he'd like to see the jobs market return to its pre-COVID state, when unemployment stood at a half-century low of 3.5%. It's now at 10.2%. Blinder said it will take years to do that. I hope it won't be decades, the Princeton University professor added. The bottom line for policy, a prolonged period of rock-bottom interest rates. I'd be very surprised if it's less than 3 years, said David Wilco, a former Fed official, now with the Peterson Institute for International Economics. I could see it lasting as much as 6 or 7 years if the damage from the crisis proves to be a much more long-lasting thing. Gold thrives in negative real rate territory. What the Fed is contemplating, and tonight should confirm, is that we will in negative real rate territory for several years from now. And constantly lurking will be the inflation genie getting out of control. Weimar Republic 2.0, Venezuela 2.0, Zimbabwe 2.0. We've seen all these before in other countries. Well, that's news for today. We hope you enjoyed it, and we look forward to hearing what news from US is tonight. I'm sure we'll find out about it in news tomorrow. Jump over to ainsleyBullion.com.au for all things gold and silver, Ainsley Wealth for everything crypto, and goldsilverstandard.com for our gold and silver backed token. We'll catch you tomorrow. Enjoy your day.